Ladies and gentlemen, Asian guy here. It is January the 2nd, 2026. The first real trading day of what I'm telling you right now will be the most explosive year for silver in modern history. Happy New Year? No, folks. Happy New Era. Because what happened on December 31st and what kicked in on January 1st has changed the game forever. And I mean forever. Before we dive into the carnage, the chaos, and the opportunity of a lifetime, I have some unfinished business. You see, the financial media, CNBC, Bloomberg, Reuters, the whole corrupt establishment, they spent the last 48 hours telling you everything is fine. Calm markets, routine year-end adjustments, no stress signals. I watched their coverage with my jaw on the floor. Are these people delusional or just paid liars? Because the data, the actual data from the Federal Reserve itself, screams the exact opposite. And then we have the YouTube gurus, the guys who spent all of 2025 telling you silver was a bad investment. The guys who said China would never restrict exports. The guys who laughed at stackers and called us conspiracy theorists. Where are they now? Silent, hiding, deleting old videos. Because everything we warned about is now headline news. Everything we predicted is now reality. And they cannot handle being wrong. Let me tell you something, folks. I do not do this for clout. I do not do this for views. I do this because someone has to tell the truth when the entire financial establishment is built on lies. Someone has to stand up for the little guy, the stacker, the veteran, the single mom trying to protect her family's wealth from the money printers. That is why I am here. That is why we're here together. Now, let me hit you with what just happened, because the mainstream will never explain it properly. On December 31st, 2025, the final trading day of the year, something unprecedented occurred. Banks rushed to the Federal Reserve standing repo facility and borrowed a staggering $74.6 billion in overnight liquidity. Let that number sink in. $74.6 billion, collateralized with $31.5 billion in treasuries and $43.1 billion in mortgage-backed securities. This was not a routine transaction. This was a five-alarm fire. The previous record? $50, $35 billion back in October. We did not just break the record, we shattered it by 48%. And just 2 days before, on December 29th and 30th, usage was sitting at $25 to $26 billion. Elevated, yes, but nothing compared to what came next. In 48 hours, it nearly tripled. Why? What happened? I will tell you what happened. Silver happened. The silver derivatives market melted down, and the banks could not meet their margin calls without running to Daddy Fed for emergency cash. That is the truth they do not want you to know. But wait, it gets better. Or worse, depending on which side of this trade you're on. On January 1st, 2026, yesterday, China's export licensing regime for refined silver officially kicked in. This is not speculation anymore. This is not a rumor. This is reality. The world's largest producer of refined silver, controlling nearly 70% of global supply, just put the brakes on exports. Licenses required. Government approval needed. Strategic resource classification activated. Do you understand what this means? The silver supply chain that the West depended on for decades just got choked, not slowed, choked. Industry analysts estimate 50 to 70% reduction in Chinese silver exports. Some say it could be worse. And the thing is, nobody knows exactly how bad it will get because China is not telling us. They are playing chess while the West plays checkers. Meanwhile, the bullion banks, JP Morgan, HSBC, Citi, Bank of America, they are sitting on the largest short positions in history. CFTC data from early December showed banks net short approximately 212 million ounces on COMEX alone. And that is just the regulated market. The OTC derivatives, the off-balance sheet monsters, those are estimated in the hundreds of billions in notional exposure. When silver ripped from $30 to over $80 in 2025, those shorts bled red ink like never before. And now, with China cutting supply and industrial demand exploding from AI, solar, and EVs, those shorts are not just bleeding, they are hemorrhaging. They are dying. And the only thing keeping them alive is the Federal Reserve's money printer. That $74.6 billion repo hit, that was the defibrillator, the emergency shock to keep the patient from flatlining. But here's the thing about defibrillators. They buy you time. They do not cure the disease. And the disease in this market is terminal. Folks, I want you to understand something very clearly. What we are witnessing right now is not a correction. This is not a pullback. This is not normal market volatility. This is the unraveling of a decades-long manipulation scheme. The bullion banks suppressed silver prices for 40 years using paper contracts, spoofing, and derivative tricks. They made billions while stackers suffered. They laughed at us. They called us fools. But now the physical reality is biting back. You cannot eat paper. You cannot wire electronics with futures contracts. You cannot build solar panels with COMEX IOUs. The world needs real silver, and there's not enough of it, not even close. As of today, the silver market is running a structural deficit of over 265 million ounces annually, 5 consecutive years of deficits. Above ground stocks depleting, and now the largest supplier in the world just restricted exports. This is not a crisis. This is a catastrophe for the shorts, and a once-in-a-generation opportunity for everyone who stacked silver when the so-called experts told them not to. The mainstream will spin this. They will tell you China's move is temporary. They will say the repo borrowing was routine. They will claim no systemic stress exists. Do not believe them. The data does not lie. The Fed's own numbers expose the truth. And in the coming parts, I'm going to break down every single piece of this puzzle. In the next part, we will dive deep into the repo crisis, what it really means, why the Fed removed borrowing limits in December, and how this connects directly to the silver derivatives disaster. The fire is just getting started, folks. Stay with me. All right, let us decode this repo crisis piece by piece because the mainstream financial media is doing everything they can to keep you confused. They throw around terms like standing repo facility and year-end liquidity adjustments, hoping you will nod along and assume everything is fine. But I'm going to break this down so clearly that even your grandmother will understand why the financial system is on fire right now. First, what is the standing repo facility? Think of it as the Federal Reserve's emergency gas station for banks. When banks need cash fast and the private markets will not lend to them at reasonable rates, they run to the Fed. They hand over collateral, treasuries, mortgage-backed securities, and in exchange, they get cold, hard cash overnight. The rate is set at the top of the Fed funds target range to discourage overuse. Banks are supposed to use private markets first. The SRF is the last resort. But here's what happened on December 31st, 2025. Private markets said no. Or at least, private markets said the price is too high. Overnight repo rates in the private market spiked. Sources indicate rates ticked up 10 to 15 basis points above normal, which in the repo world is screaming stress. Banks looked at those rates, looked at their bleeding balance sheets, and made a choice. They ran to the Fed. $74.6 billion worth of running. Now, the apologists will tell you this is normal year-end behavior. Banks adjust balance sheets for regulatory capital calculations. Lenders pull back during holidays. Liquidity gets tight. Sure, I get it. Year-end pressures are real. But we have had year-ends every year since the SRF launched in 2021. Never have we seen anything close to this. Let me give you the numbers. October 31st, 2025, previous record, $50.35 billion. That was already elevated, people noticed. But December 31st, $74.6 billion. That is a 48% increase in just 2 months. And from the $25 to $26 billion levels just days before, we are talking nearly a triple in 48 hours. If this is routine, I am the Queen of England. But here is what really tells the story. The Federal Reserve in early December removed the aggregate borrowing limits on the SRF. Previously, there was a $500 billion cap. They got rid of it. The official reason? To encourage use and ensure smooth market functioning. Translation? They knew trouble was coming. They saw the stresses building. They preemptively opened the floodgates because they knew banks would need to drink deeply. And drink they did. Now, connect this to silver. I know the mainstream will never make this connection. They will talk about treasuries and MBS and ignore the elephant in the room. But the mechanics are crystal clear if you understand how bank balance sheets work. Banks hold trillions in derivatives exposure. The Office of the Comptroller of the Currency, OCC, releases quarterly reports on this. The Q3 2025 report showed U.S. banks holding over $700 billion in precious metals derivatives. 6 banks hold the lion's share. JP Morgan alone reported $437.4 billion in notional exposure. That is up from previous quarters. That is 62% of the total reported by major banks. When silver prices spiked from $30 to over $80 during 2025, these derivative positions got crushed. Every dollar up means billions in mark-to-market losses for those who are short. Margin calls rain down, collateral demands spike, and suddenly, banks need cash fast. Where do you get $74.6 billion in cash overnight when private markets are charging premium rates? The Fed. Now, I'm not saying the entire $74.6 billion was because of silver. Other factors play in. Treasury market liquidity was poor all year. Mortgage-backed securities have their own stresses. But to ignore the precious metals connection is willful blindness. Look at the timing. Silver had one of its most volatile weeks ever leading into year-end. Prices touched $83.62 before pulling back sharply. The CME raised margins twice in December to cool things down. First hike earlier in the month, second hike on the 30th. These margin increases forced liquidations, forced sales, forced covering, and forced banks to scramble for liquidity. The correlation is not coincidence, it is causation. And here's the kicker, the Fed knows. Why else would they remove borrowing limits just weeks before? Why else would Dallas Fed officials in October give speeches warning about GFC-like risks in interbank lending? Why else would the Fed's own financial stability report in November talk about stretched asset prices and elevated risks? They saw this coming. They prepared. And they are praying you do not notice. But we notice. We see through the narrative. We read the data they hope we will ignore. Let me be very clear about what this repo surge means for silver going forward. It means the shorts are alive, but on life support. The Fed's liquidity injection bought them time. Maybe days, maybe weeks. But it did not solve the underlying problem. The problem is that they are short hundreds of millions of ounces of a metal that is in chronic structural deficit, with the largest supplier in the world now restricting exports. You cannot print silver. You cannot create it with a keystroke. Every ounce has to be dug out of the ground, refined, and delivered. And there is not enough. The repo facility is a band-aid on a gunshot wound. The patient is bleeding internally, and no amount of Fed liquidity changes the physical reality of supply and demand. As we move forward into 2026, watch the repo numbers. The Fed releases this data daily. If we see continued elevated usage in January, that is confirmation of ongoing stress. If usage spikes again, that is confirmation of crisis deepening. The data does not lie even when the talking heads do. In the next part, we will shift focus to China, the export ban that kicked in yesterday, what it means for global supply, why Elon Musk sounded the alarm, and how this changes everything for silver prices in 2026. The dragon just breathed fire, folks, and the silver market is burning. Folks, as of yesterday, January 1st, 2026, the world changed. Not in some abstract philosophical sense. In a very concrete, supply chain shattering, price exploding sense. China's export licensing requirements for refined silver are now in effect. And if you think this is just another regulatory tweak, you are sleepwalking into a buzzsaw. Let me explain exactly what happened and why it matters more than almost anything else in the silver market right now. China is the world's dominant producer of refined silver. We are talking about approximately 70% of global refined supply. Over 6,000 metric tons annually flow through Chinese refineries. For decades, the West relied on this supply to fill its deficits. When Western mines could not keep up with demand, when industrial consumption outpaced production, Chinese exports bridged the gap. That bridge just got blown up. Starting January 1st, 2026, anyone wanting to export refined silver from China needs a government license. Not just paperwork, not just a fee, actual government approval. And from what we are hearing, only large state-connected enterprises are getting approvals. Smaller refiners, private exporters, they are frozen out. The official reasoning? Silver is now classified as a strategic resource, just like rare earths, just like certain high-tech materials. China looked at the trade wars, the tariffs, the tech restrictions coming from the West, and made a calculated decision. If you want to play hardball with us on chips and technology, fine. We will play hardball with the materials you need to build those chips. Silver is essential for semiconductors, solar panels, electric vehicles, 5G infrastructure, AI data centers, and medical devices. Without silver, modern technology does not exist. China knows this, and they just weaponized it. Now, let me tell you what the early reports are showing. Because we are now 48 hours into this new reality, Shanghai silver premiums exploded. Before the ban, premiums over spot were running $2 to $3 per ounce. As of yesterday, reports indicate premiums hitting $5 to $7 in some cases. Buyers in Asia are scrambling. Manufacturers who did not stockpile ahead of the deadline are panicking, and this is just day 2. Meanwhile, London and New York are lagging. Western premiums have not caught up yet, but they will. Oh, they will. Because the arbitrage that previously equalized global prices is breaking down. You cannot ship silver from China to London if China is not exporting. The price discovery mechanism is fragmenting. Backwardation in the futures, curve deepened overnight. Front-month contracts trading at premiums to later months. This screams immediate physical shortage. This screams, I need metal now, not in 3 months. This screams crisis. Elon Musk was one of the first major voices to sound the alarm. He tweeted about it before the holidays. This is not good. Classic Musk understatement, but he knows. Tesla alone uses millions of ounces of silver annually for batteries, wiring, and electronic components. SpaceX needs it. Neuralink needs it. Every single one of his companies depends on silver supply chains that just got choked. And it is not just Musk. Apple reportedly stockpiled silver ahead of the deadline. Samsung too. The smart money saw this coming and front-ran it. But the average manufacturer, the smaller tech firms, they are exposed. And they are about to learn a very expensive lesson about just-in-time inventory management. Let me give you some numbers to put this in perspective. Global silver demand in 2025 hit approximately 1.2 billion ounces. Mine supply was around 850 million ounces. Recycling added maybe 180 million. Total supply roughly 1.03 billion ounces. Deficit 170 to 200 million ounces. And that was with Chinese exports flowing. Now remove 50 to 70% of Chinese exports. Some analysts estimate this could widen the deficit to 265 million ounces or more in 2026. We are talking about a gap that cannot be filled. There is no spare capacity in Western mines. There is no secret stockpile waiting to be released. The silver simply does not exist. Above ground stocks globally are estimated at less than 1 billion ounces. Half of that is industrial, locked up in products and manufacturing. Half is investment held tightly by central banks, ETFs, and private stackers. You think those holders are selling into this shortage? You think they are going to bail out the banks at these prices? No chance. The squeeze is structural. It is not going away. And it is only going to intensify. Now, here's what the mainstream will tell you. They will say China's licensing is flexible. They will say exemptions will be granted. They will say supply will normalize. Do not believe it. China has made strategic resource plays before. Look at rare earths. Once they restricted exports, prices exploded and never fully came back down. They held that leverage and used it. Silver is next. In fact, silver is arguably more important because it touches every single tech sector simultaneously. And here is the geopolitical angle the media ignores. China is not just restricting exports. They are stockpiling. Their central bank has been quietly accumulating gold for years. Reports suggest they are doing the same with silver through state-owned enterprises. They are preparing for a world where hard assets matter more than paper promises. Meanwhile, the West is caught flat-footed. The US has no strategic silver reserve. Europe has minimal stockpiles. We outsourced our supply chain to a geopolitical rival, and now we are paying the price. This is not a drill, folks. This is the new reality. China controls the silver supply. They have turned the valve, and the Western industrial machine is about to sputter. For silver stackers, this is validation. Everything we said, everything we warned about, it is happening. The price implications are massive. We will talk specific targets soon. But first, we need to understand who is bleeding the most from this chaos. In the next part, we dive into the bullion bank bloodbath, JP Morgan's $437 billion exposure, the 212 million ounce short position, and why the next few weeks could see bank capitulation like never before. The banks are burning, folks, and we are just getting warmed up. All right, folks, let us talk about the real victims of this silver explosion. And I use the word victims with the heaviest sarcasm possible, because the bullion banks, JP Morgan, HSBC, Citi, Bank of America, these are not victims. These are the architects of a 40-year manipulation scheme that is finally collapsing around them, and I cannot pretend to feel sorry. Let me walk you through the numbers. Because when you see the scale of what these banks have done, you will understand why they needed $74.6 billion from the Fed just to survive year-end. The Office of the Comptroller of the Currency, the OCC, releases quarterly reports on derivatives held by U.S. banks. The Q3 2025 report is a masterpiece of horror if you know how to read it. Total precious metals derivatives at U.S. commercial banks, over $700 billion in notional value. That is not a typo. $700 billion in bets on gold, silver, platinum, and palladium. And the concentration is insane. 6 banks hold the vast majority, but 1 bank dominates. JP Morgan Chase reported $437.4 billion in precious metals derivatives. That is 62% of the entire reported market. That is 1 bank holding almost 2/3 of all precious metals derivatives. Let me put this in perspective. Annual global silver mine production is worth approximately $25 billion at current prices. JP Morgan's derivatives exposure is 17 times that. They have leveraged themselves to an insane degree. And when prices move against them, the losses are catastrophic. CFTC data from early December showed that banks were net short approximately 212 million ounces on COMEX silver futures. That is the equivalent of 26,500 contracts at 5,000 ounces each. And those are just the regulated positions. The OTC market, the over-the-counter swaps and forwards, is estimated to be multiple times larger. When silver went from $30 to $83 in 2025, every single ounce of that short position lost $53. Do the math. 212 million ounces times $53 equals $11.2 billion in paper losses on COMEX alone. Add the OTC exposure, and you are looking at potential losses in the tens of billions. Whispers in the market, and I must be clear these are unconfirmed rumors, suggest JP Morgan alone may have taken $4.8 billion in unrealized losses on silver positions by year-end. There are also rumors of a major bank flipping from short to long on 750 million ounces of notional exposure. True or not, the pressure is real. The mechanics fit perfectly. And here's the thing about derivative losses. They trigger margin calls. And margin calls trigger liquidity demands. And liquidity demands trigger trips to the Federal Reserve's standing repo facility. The daisy chain is clear. Now, let me explain the manipulation playbook these banks have used for decades, because understanding the past helps you see why the present is so explosive. The game was simple. Banks would accumulate massive short positions in COMEX silver futures. At key technical levels, they would dump contracts to trigger stop losses and drive prices down. This is called spoofing. JP Morgan paid $920 million in fines in 2020 for exactly this behavior. Traders literally called it the hammer. Meanwhile, they would use their suppressed prices to accumulate physical silver cheaply. They were short on paper, but long on physical. The perfect scam. Suppress the price, buy the real metal, and profit on both sides. But this game only works when physical supply is abundant, when there is enough metal to satisfy both industrial demand and investment demand, when China is exporting freely, when deficits are manageable. None of those conditions exist anymore. The physical market has flipped. Deficits are chronic. China is restricting. Industrial demand is exploding. And investment demand, fueled by people like you and me who see through the manipulation, is surging. Suddenly, the banks cannot cover their shorts without spiking prices. Every time they try to buy, the market rips higher. And the higher it goes, the bigger their losses. The larger their margin calls, the more desperate their liquidity needs. It is a death spiral, and we are watching it in real time. The CME, the exchange itself, sees what is happening. That is why they raised margins twice in December. First, earlier in the month to around 15% of contract value. Then again on December 30th. These margin hikes force speculators to post more cash or liquidate positions. It is designed to cool volatility, but it is also designed to shake out weak hands. The banks wanted this. They wanted retail and hedge funds to panic sell so they could cover their shorts at lower prices. And to some extent, it worked. Silver dropped from $83 to around $72 on the margin hikes and year-end profit-taking. But here is what they did not expect. The dip got bought. Hard. ETF inflows continued. Physical demand at dealers stayed elevated. And now, with China's export ban in effect, the fundamental picture is even more bullish than before. The banks bought themselves a few days. Maybe a week, but the underlying problem remains. They are short a metal they cannot source without exploding prices further, and the Fed's liquidity injection just delays the inevitable. What happens next? In my view, one of two things. Either the banks continue bleeding and eventually capitulate, covering their shorts at massive losses and sending silver to the moon. Or they try to manipulate again, and this time, the physical market overwhelms them completely. Either way, silver wins. Stackers win, the manipulation ends. Some whispers suggest at least one major bank is already flipping from short to long. If true, that is the first domino. When one bank breaks ranks, the others will scramble to follow. And when everyone is trying to buy at the same time in a market with chronic deficits, prices do not rise. They explode. In the next part, we will examine the physical market chaos, vault drains, COMEX delivery surges, and premiums that are screaming shortage louder than ever. The banks can play paper games, but they cannot print silver, and that is their fatal flaw. Folks, let us leave the paper games behind for a moment and focus on what really matters, the physical silver market. Because you can manipulate futures all you want. You can spoof orders. You can dump paper contracts at 3 a.m. when nobody's trading. But at the end of the day, someone needs actual metal. And that is where the manipulation scheme is breaking down spectacularly. Let us start with COMEX, the supposedly deep and liquid market that sets global silver prices. What is happening in those vaults should terrify the banks. Throughout December 2025, we saw elevated delivery demands. Normally, COMEX sees 2 to 5 million ounces stand for delivery each month. Most traders roll their contracts forward. They do not actually want the metal. They are just speculating on price. But December was different. Over 10 million ounces stood for delivery. Takers said, I want my silver. Now. Not next month. Now. This is significant because COMEX works on fractional reserve principles. They do not have enough physical silver to satisfy all contracts simultaneously. They depend on most participants never actually demanding metal. When delivery demands spike, it exposes the mismatch between paper claims and physical reality. And here is the even more alarming trend. Eligible stocks, the metal sitting in COMEX warehouses available for delivery but not yet committed, have been converting to registered at a frantic pace. Registered means it is earmarked for delivery, ready to go. This conversion signals that holders are locking in metal rather than leaving it available for the broader market. COMEX total inventories dipped below 300 million ounces mid-year. They have stabilized somewhat, but the churn is insane. Metal coming in, metal going out, eligible converting to registered being delivered. The velocity is unprecedented. And the vault breakdown is even more telling. JP Morgan's vaults, the same JP Morgan with $437 billion in derivatives exposure, have seen consistent outflows. Millions of ounces moving out weekly. Some of that is client withdrawals. Some is delivery satisfaction. But the pattern is clear. Metal is leaving COMEX, and it is not coming back. Whispers from industry insiders suggest manufacturers pulled 44 tons, that is 1.4 million ounces, from vaults in the final week of December alone. Why? To front-run China's export controls. Smart money saw the deadline coming and secured supply while they could. Now let us talk about premiums. This is where the physical versus paper disconnect becomes obvious. Retail premiums for silver coins and bars are elevated and climbing. Before 2025's rally, you could buy American Silver Eagles at $3 to $5 over spot. By year end, premiums hit $8 to $12 in many cases. Some dealers charging even more. Generic rounds, $4 to $6 over spot. Bars, similar story. Why? Because refiners cannot keep up with demand. The U.S. Mint is backlogged. Private mints are running overtime. And they are competing with industrial buyers for the same limited refined supply. Shanghai premiums, as I mentioned earlier, exploded to $5 to $7 over spot as China's export controls kicked in. But here is the fascinating dynamic. Normally, arbitrageurs would ship metal from lower premium markets to higher premium markets, equalizing prices globally. But with China restricting exports, that flow is broken. Metal can go into China, but it is not coming out, at least not freely. This creates a one-way valve effect. Silver gets sucked into the Chinese market, but the West cannot access it. Global supply tightens. Western premiums rise to match. We are witnessing the early stages of a great decoupling. Paper prices on COMEX say one thing. Physical premiums in the real world say another, and the gap is widening. Backwardation in the futures curve confirms this. When front-month contracts trade at premiums to later months, it signals immediate scarcity. It means buyers are willing to pay more for silver today than silver 3 months from now. That is not normal. In a well-supplied market, later contracts trade higher due to storage and financing costs. Backwardation means the market is broken. We saw a sharp backwardation mid-December as prices spiked. Even after the pullback, the curve remains inverted at the front end. This is the market screaming, "We need metal now." And here is where it gets really interesting for stackers and investors. ETF inflows have been massive. SLV, the largest silver ETF, added approximately 20 million ounces in Q4 2025, according to trust filings. That is real metal being pulled into vaults to back shares. When ETF demand is high, it competes with industrial and retail demand for the same limited supply. Some critics say ETFs are paper proxies that do not help the physical market. That is partially true. But when SLV adds 20 million ounces, that metal has to come from somewhere. It tightens the market. It adds to the squeeze. Central banks are also in the game. Russia explicitly budgeted for silver reserve accumulation in 2025 to 2027. India's imports surged 60% year over year. Poland, Singapore, and other nations have been adding precious metals quietly. When central banks compete with industry and investors, supply gets even tighter. Above-ground stocks globally are estimated at less than 1 billion ounces. That sounds like a lot until you realize annual demand is 1.2 billion ounces. We are literally consuming more than exists above ground each year. The difference comes from mine production and recycling, but those sources are not keeping pace. The math does not lie. The physical market is in crisis, and no amount of paper manipulation can change the fact that the silver is not there. In the next part, we will get technical. Gamma squeezes, options mechanics, how the derivatives market is about to amplify this move in ways that will shock even the most bullish silver investors. The powder keg is set, the fuse is lit, and we are about to witness an explosion. All right, folks, time to put on our nerd hats and dive into the technical mechanics that are about to amplify this silver move beyond anything the mainstream expects. We are talking gamma squeezes, delta hedging, options mechanics, and the feedback loops that turn rallies into rockets. If you understand what I'm about to explain, you will see why silver is not just going to rise, it is going to explode. First, let us define terms. Gamma is a measure of how fast delta changes. Delta is how much an option's price moves relative to the underlying asset. Market makers who sell options hedge by buying or selling the underlying. As prices move, delta shifts, forcing adjustments. Gamma measures the acceleration of those adjustments. In simple terms, when you have a lot of call options outstanding at certain strike prices and the underlying asset starts moving toward those strikes, market makers have to buy the asset to hedge. The more they buy, the higher the price goes. The higher it goes, the more delta shifts, forcing more buying. Gamma turns into a self-reinforcing rocket engine. This is exactly what happened with GameStop in 2021. Retail piled into call options. Market makers hedged by buying stock. Price exploded. Gamma squeeze. Now apply this to silver. CME data shows options open interest on silver futures ballooned approximately 40% in Q4 2025. Call options outnumbered puts by a ratio of 2.1 at strikes above 70. That means a massive wall of calls sitting at $75, $80, $85, $90 and higher. When silver touched $83.62 in late December, gamma exposure went nuclear. Market makers scrambled to delta hedge by buying futures. This amplified the move. Even though prices pulled back on margin hikes, the setup remains in place. Those calls did not disappear. Open interest is still elevated, and as we enter January with China's export ban now reality, any renewed upside will trigger the same mechanics. Market makers will buy, gamma will accelerate, prices will spike, but it gets even more interesting. The banks are not just passive participants. They are the market makers. JP Morgan, Goldman Sachs, Citi, they run the desks that hedge these options. They are simultaneously short silver futures and forced to buy when gamma squeezes hit. It is a conflict of interest that amplifies their pain. Think about it. They are short from their proprietary positions, but they have to buy to hedge customer options. Every dollar up hurts their shorts and forces them to buy more. The feedback loop is vicious. Now add the OTC dimension. Over-the-counter options are not reported publicly, but industry estimates suggest OTC options activity in silver dwarfs the exchange-traded market. Bespoke calls sold to funds, industrials, and sovereigns. These positions require hedging too, and when prices move, the hedging activity shows up as mysterious buying pressure that pushes prices even higher. There are rumors, unconfirmed but persistent, that at least one major Asian sovereign wealth fund has been accumulating long silver call exposure via OTC structures. If true, this represents billions in notional that requires hedging. When these positions go in the money, the buying pressure could be overwhelming. Let us also talk about the short squeeze mechanics specifically. CFTC data showed banks net short 212 million ounces on COMEX. As prices rise, these shorts face increasing margin calls. At some point, the pain becomes unbearable and they cover. Covering means buying. Buying pushes prices higher. Higher prices cause more shorts to cover. Another feedback loop. We saw this in December. As silver raced from $70 to $83, short covering accelerated. Managed money funds who had been short started flipping long. The CFTC commitment of traders reports showed the shift. Non-commercial shorts collapsed while longs surged. But here's the thing. The commercial shorts, the banks, they have not fully capitulated yet. They are bleeding, but they are still short. Why? Because covering 212 million ounces in a market with tight supply would spike prices to levels they cannot afford. It would be admitting defeat. It would be billions in realized losses. So they hold, they hope, they pray for prices to drop so they can cover at better levels. But every day that China's export ban remains in effect, every day that industrial demand continues, every day that stackers keep stacking, their position gets worse. At some point, hope runs out. At some point, one bank breaks. And when one breaks, they all break. Because they know the first one to cover pays the lowest price. The last one to cover pays the highest. It is a prisoner's dilemma, with a guaranteed losing outcome for those who hold longest. Market whispers suggest this breaking point could come in Q1 2026. The combination of physical shortages, continued high prices, and relentless demand may force capitulation sooner than anyone expects. Now, let me tie this back to the repo crisis. The $74.6 billion borrowing on December 31st was the bank's buying time. They used Fed liquidity to meet margin calls and survive year-end, but that was a one-day fix. The margin calls do not stop. The losses do not reverse. They need prices to drop, and prices are not cooperating. If we see silver push back above $80 in January, which I fully expect given the China situation, the gamma squeeze and short squeeze mechanics will combine. The rocket will ignite. And targets of $100, $120, even $150 become achievable within weeks, not months. The technical setup is as bullish as I have ever seen. Open interest skewed to calls, shorts trapped, physical market and backwardation, and the fundamental catalysts, China, deficits, industrial demand, all pointing higher. In the next part, we will zoom out and look at the big picture. Historical parallels to 1980 and why this time is bigger, price targets for 2026, and how to position your portfolio to capture the maximum gains from this once-in-a-generation opportunity. The stage is set, the players are in position, and the final act is about to begin. Folks, let us step back and appreciate the historical magnitude of what we are witnessing. Because while the headlines focus on daily price moves and repo numbers, the bigger picture is even more stunning. We're living through a silver moment that will be studied in financial history books for generations. And I am not exaggerating. The last time silver captured the world's attention like this was 1980. The Hunt brothers, Nelson Bunker and William Herbert, tried to corner the silver market. They accumulated massive positions in both physical and futures, driving prices from $6 per ounce to over $50 in a matter of months. The squeeze was legendary. Shorts were annihilated. The Hunts became billionaires on paper. Then it collapsed. The COMEX changed the rules mid-game, limiting purchases to liquidation only. Margin requirements exploded. The Hunts could not meet the calls. Prices cratered. They ended up bankrupt. The establishment won. But here's why 2025 and 2026 are different. And not just different, bigger, much bigger. In 1980, global silver supply was abundant. There were no structural deficits. The Hunt squeeze was purely speculative, driven by two brothers with deep pockets, but no fundamental support. When the rules changed, the trade collapsed because there was no underlying demand to sustain prices. Today, we have chronic structural deficits, 5 consecutive years of demand exceeding supply, 265 million ounce gaps projected for 2026, industrial demand from solar, EVs, AI, semiconductors that did not exist in 1980, and now the world's largest refiner restricting exports. The fundamentals are screaming higher. This is not speculation. This is supply and demand reality. In 1980, the Hunts were alone, 2 men against the establishment. Today, an entire global movement of stackers, investors, and even nation-states are accumulating. Russia budgeting for silver reserves, China hoarding domestically, India importing record amounts, central banks diversifying, retail investors stacking physical like never before. The demand side is broad, deep, and persistent. In 1980, the paper market was king. COMEX could change rules and crush the squeeze. Today, the paper market is exposed. The ratio of paper claims to physical ounces is estimated at 350 to 400 to 1. That means for every ounce of real silver, there are 350 to 400 ounces of paper promises. When holders start demanding delivery, the pyramid collapses. We are already seeing this. COMEX delivery demands at record levels, vault drains accelerating, ETF inflows pulling metal. The paper versus physical disconnect is widening daily. In 1980, there was no China factor. Silver flowed freely in global markets. Today, 70% of refined supply is controlled by one nation that just restricted exports. This is not a speculative squeeze. This is a supply chain shock. And here's the most important difference. In 1980, the Federal Reserve under Paul Volcker was raising rates aggressively to kill inflation. Interest rates hit 20%. Holding non-yielding silver became expensive. The opportunity cost crushed the trade. Today, the Fed is cutting rates. They removed QT in late 2025. They are preparing to ease further in 2026. Interest rates are headed lower, not higher. Holding silver costs nothing in relative terms. And as fiat currencies get debased by endless liquidity, hard assets like silver become more attractive, not less. The 1980 squeeze failed because conditions turned hostile. The 2026 squeeze is succeeding because conditions are perfect. Now, let us talk price targets, because I know that is what you really want to hear. Short-term January 2026, I expect silver to test and break $80 again. The dip to $72 was profit-taking and margin hike shakeout. Support at $70 held. The buyers stepped in. With China's export ban now reality, the fundamental case has strengthened, not weakened. Q1 2026, $100 silver is absolutely in play. If we see any hint of bank capitulation, any short covering cascade, we could hit $100 by March. The gamma squeeze mechanics we discussed earlier will amplify the move. Mid-2026, $120 to $150 base case. Deficits widen. Industrial demand surges. Solar installations accelerate. EV production ramps. AI data centers multiply. All of this consumes silver, and there is not enough supply. Year-end 2026, supercycle scenario, $200 or higher. If central banks openly add silver to reserves, if the paper market breaks completely, if multiple banks flip from short to long simultaneously, we could see prices that seem insane today. Remember, silver hit $50 in 1980 when annual demand was a fraction of today's. Adjusted for inflation, $50 in 1980 equals approximately $180 today. We have not even reached inflation-adjusted highs yet, and the fundamental case is exponentially stronger now. The gold-silver ratio also suggests massive upside. Historically, the ratio averages 40 to 60 to 1. It started 2025 around 90 to 1. It is now around 80 to 1. But in bull markets, silver outperforms gold dramatically. Ratios of 30 to 1 or even 20 to 1 are possible in blow-off tops. If gold hits $5,000, as Bank of America and others project, silver at a 40 to 1 ratio would be $125. At 30 to 1, $166. At 20 to 1, $250. These are not fantasy numbers. These are mathematical extrapolations based on historical patterns and current fundamentals. The opportunity in front of us is generational. The setup is perfect. The catalysts are in place, and the banks are bleeding. In the final part, we will bring it all together: portfolio strategy, specific action steps, and a final call to arms for the silver revolution that is just beginning. This is our moment, folks. Let us seize it. All right, folks, we have covered the repo crisis, the China bomb, the bullion bank bloodbath, the physical market chaos, the gamma squeeze mechanics, and the historical parallels. Now it is time to bring it all together into actionable strategy. Because knowledge without action is worthless, and the opportunity in front of us is too important to waste. Let me give you my portfolio blueprint for 2026. This is not financial advice. I'm just a guy on YouTube sharing what I am doing. But I believe this framework captures the asymmetric opportunity in silver right now. Core position. 50% of your precious metals allocation should be physical silver, bars for bulk storage. 100-ounce bars from reputable mints offer the lowest premiums per ounce. Coins for liquidity and recognizability. American Eagles, Canadian Maples, Austrian Philharmonics. Yes, premiums are elevated, but in a true crisis, recognizable coins trade easier. Store your metal securely. Home safes for immediate access. Private vaults for larger holdings. Diversify storage locations if your stack is significant. And whatever you do, if you do not hold it, you do not own it. Allocated storage with reputable custodians is okay, but unallocated storage with banks is paper. Avoid it. Miners, 30% of your allocation. This is where leverage happens. Miners turn fixed costs into explosive profits when silver prices rise. At $30 silver, many miners scrape by. At $80 silver, they print money. And at $150 silver, generational wealth creation. Names to consider. First, Majestic Silver, pure play silver miner, up big in 2025, but still cheap on cash flow metrics. Hecla Mining, diversified precious metals producer with strong U.S. assets. Pan American Silver, large cap stability with global operations. Kerr Mining, leveraged upside with cost improvements underway. Endeavor Silver, junior explorer with growth potential. ETFs like SIL or SILJ provide diversified miner exposure without single stock risk. I personally prefer individual names for maximum upside, but ETFs work for simplicity. Silver ETFs, 10% allocation, SLV or PSLV for direct silver exposure. PSLV from Sprott is fully allocated physical, meaning they actually hold the metal. SLV has some counterparty concerns, but offers higher liquidity. Use these for trading around core positions. If you want to add exposure quickly on a dip, ETFs are convenient. Options. 10% allocation for the bold. This is high risk, high reward territory. Buy call options on SLV with 3 to 6 month expiration. Strikes at $80, $90, $100. If silver rips, as I expect, these calls could return 5 to 10 times your investment. But if you are wrong, you lose the premium. Size accordingly. For miners, call options on First Majestic or Hecla offer even more leverage. Implied volatility is elevated post-spike, so wait for pullback days to get better entry prices. Cash, keep a dry powder reserve, maybe 10%. The market will give you opportunities. Dips happen. CME margin hikes happen. Panic selling by weak hands happens. When those moments arrive, having cash to deploy is essential. Do not be fully invested at the top of a short-term spike. Buy fear, sell euphoria, rebalance quarterly. As silver runs, your allocation will shift. If physical goes from 50% to 70% of your portfolio, consider trimming and redeploying to miners or other assets. Take some profits along the way. Nobody went broke taking gains. Now, broader portfolio considerations. Reduce fiat exposure. The Fed is printing. The dollar is weakening. Inflation is persistent. Holding cash beyond your dry powder reserve is a losing game. If you have savings rotting in a bank account earning 2%, while inflation runs 5% plus, you're losing purchasing power every day. Avoid long-duration bonds. When rates are volatile and the Fed is easing, bonds are a minefield. You might catch a rally, but the risk-reward is poor compared to hard assets. Real estate with caution. Property can be a good inflation hedge, but valuations are stretched in many markets. Do not over-leverage into an illiquid asset class. If you own property, great. If you're looking to buy, be selective. Bitcoin as digital complement. I know some of you are crypto believers. Bitcoin has its place as digital gold. But silver has industrial utility that Bitcoin never will. Hold both if you like, but do not neglect the metal that powers the modern world. Final thoughts. What we are witnessing is not just a trade. It is a paradigm shift. The 40-year suppression scheme is ending. The paper versus physical disconnect is resolving in favor of physical. The banks are bleeding, the Fed is printing, and silver is rising. This is the wealth transfer we have been waiting for. From Wall Street to Main Street, from the manipulators to the stackers, from paper pushers to those who hold real money. But you have to act. Knowing is not enough. You have to stack. You have to position. You have to hold through volatility. You have to ignore the mainstream telling you to sell. You have to trust the fundamentals when the headlines scream fear. 2026 will be legendary for silver. I truly believe that. The setup is perfect, the catalysts are aligned, and the momentum is building. So here is my call to action, folks. Stack silver today. Do not wait for the perfect dip. Do not overthink it. Every ounce you buy is a vote against manipulation. Every ounce is a step toward financial freedom. Every ounce is a shield against the fiat insanity consuming the world. Buy miners. Hold them with diamond hands. These stocks are going to multiply, and when silver hits $150, you will be glad you positioned early. Join the community. Share this knowledge. Wake up your friends and family. The more people who understand what is happening, the harder it is for the establishment to rig the game. This is Asian Guy signing off on the first real trading day of 2026. The banks are burning. We are winning. And the best is yet to come. Stay vigilant, stay humble, stay stacked. I will see you at the next breakout.